I'm Ernie Humphrey, Educational Programs Leader for Performative, the largest online community for corporate finance, accounting, treasury, and related professionals. I'd like to welcome everyone to today's webinar, Hiring, Paying, and Retaining Employees Across the Globe, Compliance and Best Practices, What You Need to Know in 2014. As your organization expands internationally, the complexity of your operations will increase. The manner in which your company hires, pays, and retains your employees is critical to driving sustainable growth in international markets. Processing multinational payrolls, expatriate versus in-country staffing to engage and retain the right talent, paying employees on time, and complying with local regulations can leave room for error and lead to significant compliance and business risk exposures. Today we'll discover the best practices and common pitfalls when planning for and executing your international staffing strategies in 2014 and beyond. I would like to thank High Street Partners, whose Movement to Thought leadership helps us make this webinar possible and delivered at no cost. A quick note on today's agenda. First, we'll have a presentation for our featured speaker. Then we'll move to an interactive Q&A session where we'll spend the remainder of our hour. We would like this to be an interactive experience for you. So if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. We can't promise to get them all on, but we will do our best and we'll follow up afterwards if any we do not get to today. A few logistical notes about the webinar. Links to today's presentation and video recording of the webinar will be sent out to all attendees in 24 hours of the event. Those who would like CPE credit will need to answer all polling questions during the event and should have pre-registered for CPE credit. For any questions on CPE credit, please send an email to cpe@performative.com. For those attendees who qualify for CPE credit, a CPE certificate will be emailed to you within 24 to 48 hours of the event. Again, we encourage you to ask questions on today's topic via the questions box in your GoToWebinar control panel at any time during the webinar. Finally, immediately following the webinar, you'll be asked to take a short survey about the webinar today. We greatly appreciate your feedback regarding our event today, as we always strive to improve the ROI we offer our event attendees for their valuable time. A quick word about Performative. Performative is the largest online community and resource for senior level corporate finance, accounting, treasury, and related leaders. Performative connects corporate finance leaders to provide instant advice and insights on the tough strategic and financial challenges they face every day. Let's get started by introducing today's featured speaker, Katie Davis, Senior Director, High Street Partners. Katie oversees High Street Partners advisory client engagements across 5 continents. Katie is an expert in a wide variety of cross-border issues, including HR, tax, IP, and immigration consulting. Katie also provides hands-on client services to many of the firm's U.S.-based accounts with operations in Europe. With that, it is my distinct pleasure to hand the floor to Katie Davis. Katie, the floor is yours. Please take it away.
Thank you, Ernie, and good morning, good afternoon, everyone. I just want to start today's session, even though we're talking about HR matters in terms of the global context of hiring and retaining people. When you're looking at international business, you have to always start with the company structure, the international context of what entity is going to employ or be available to hire people. And as HR practitioners, you might say to me, well, why does that really matter? Surely that's a finance or a corporate tax issue. The reason it matters is when you're trying to hire and retain international employees, it's critical to show some sort of commitment to the local market. If you just have a very basic registration in a country, such that you're able to perhaps just pay somebody, if you're trying to tempt them in from larger organizations in terms of hiring, it can lead to some question around your commitment to the local market. So not only is there an HR angle of actually thinking about what structure do we have in place to hire people, but this also then in turn dictates elements such as what registrations are required and the timeline that may be required to undertake that setup, which in turn can obviously impact on the hire of the timing and the speed of being able to hire somebody. So if you're making an offer of employment to somebody, expecting them to start in 2 weeks' time, you need to be aware of what entity exists, what registrations may be required, and what do you need to put in place, both from a timeline perspective, but also from a financial budgetary and cost perspective. So for example, some practical examples, in France it is in theory possible to have a payroll-only registration, but if you set up a payroll-only registration, it will actually restrict or limit the number of benefit providers or insurance carriers that will actually provide you with insurance. So there's a knock-on effect in terms of cost. In the UK, if you don't have a local entity, you're not going to be able to necessarily have a bank account. And if you don't have a local bank account, it limits the opportunity to set up direct debits with certain benefit providers. Again, some very practical examples, but it's important to understand the company structure when you're thinking about the international hiring of staff. So in turn, the actual activities of the employees in territory, the number of employees that you're going to have, will dictate whether or not you actually need to have some form of entity versus a payroll only or a minimalistic registration. And the reason that's important is because it will trigger what we call a permanent establishment or a corporate tax nexus in territory. This again stems into the whole finance and tax world, but we've got to look at the activities of those individuals to see whether or not by hiring people in country you're actually creating a compliance obligation for local corporation tax. So it's important to understand the impact of hiring people locally on the structure, as well as in turn what that structure may mean from your hiring plans. And in terms of the sort of types of entities that you'd be typically looking at, it's either going to be a representative office, which will typically be for a marketing presence. It's minimal presence, low risk, and means that there is no corporate tax nexus. Or you go up one stage into a branch or a subsidiary type of entity, which does have local corporation tax implications. And the decision about which of those entities is the right entity will be dictated by things like, are you going to be taking office space, how many employees, and what's the timeline of commitment to the particular territory, as well as the nature of the activities that those employees are undertaking. So when we're looking at the international staffing profile, we will turn to three types of personnel. Local employees basically means people that are employed locally under local terms and conditions. Invariably they'll be local nationals, not necessarily always the case, and you need to be careful about employing people on local terms who are not local nationals due to work permit and visa requirements. The second category of population is your expatriate employee. These are typically your globally mobile staff who may be transferring from head office or from another regional office into territory. And the third type of personnel are third-party independent contractors. Question, are they really contractors or are they really bona fide employees? And we'll look at that in more detail. Within local hire employees and expatriates, there will invariably be some form of requirement to account for local payroll. That's both in terms of paying local income taxes, social security, and reporting obligation, as well as obviously funding that payroll in local currency. To add to the complexity when you're dealing with expatriates, there are definitely going to be visa and immigration considerations, and that's important because it will affect the timeline of how quickly you can get your expatriate employee into territory. And it's amazing how many of my customers I find who have sort of flouted the immigration rules and have got illegal workers basically in territory. Even though they're from the US, they're working, let's say, for 6 to 9 months in Europe, and they don't have a work permit. So it's something which can just happen, and people don't mean it to happen, but it often does happen. And then the third category, as I said, is question mark whether or not your contractor could be deemed to be actually a de facto employee. So we need to look at whether or not you're bending the rules to try and potentially mitigate employment and payroll obligations in territory. Not intentionally, but just as a natural sort of inadvertent action that happens. The biggest issue that we see is that US corporations kind of naturally assume that whatever goes in the US will actually work overseas. And whilst that may sound patronizing, and it's certainly not intended to be, it often happens. So in terms of employment law, benefit practice, assumptions are made, and I think that the key learning here is always to do the research and find out what are local practices in terms of local employment laws, benefit practices, etc. Because failure to address those points up front not only can lead to obviously breaches in terms of non-compliance both from a payroll tax, HR and employment law perspective, but actually more fundamentally from an HR perspective internally can somewhat invalidate your perception with the employees that you're not taking account of local market practice, being culturally aware and being sensitive. And the result of that is, having spent quite a lot of money on hiring people, you end up with a dissatisfied local employee population. So the key message here is that everything will be different overseas, and not to be afraid of asking the basic questions and getting all that information up front before you start proceeding to hire in the overseas territory. Here we've got a very basic US offer letter that may be familiar. It outlines the basic salary, PTO requirements, some extra compensation such as share-based compensation, and importantly notes the fact that the employment is at will. It's basically a very simplistic offer letter. It outlines the heads of terms of the employment relationship, and these US-style offer letters simply do not work in any country outside of the US. So why don't they work? Starting with the employment at will. Employment at will basically allows companies to pretty easily terminate employment relationships. I know it's not as straightforward as that in the US, but the general premise is that you basically are can get rid of the employee at your own discretion. This is not a common concept, and it's actually illegal in many countries outside of the US because there are domestic termination rules that apply. So it's important that you understand, when you're terminating an employee, what are the statutory obligations, what are the contractual obligations, and what is best practice in terms of the process to terminate, as well as compensatory items that might need to be paid. It's always advisable to have a locally compliant employment contract that's actually written in accordance with local employment law. I say advisable. In NAON, in most cases, it's a statutory obligation to have an employment contract that's going to be written in accordance with local legislation. The reason is that it's important for you as the employer to understand the obligations that you're under, as well as, again, ensuring that the employee appreciates the fact that you are conversant with local employment law and therefore sensitive to their own market. In addition, whilst there may be federal or national laws that may be applied, in many countries, such as Switzerland and China, there are regional or cantonal, provincial variations to the employment legislation that may go into the employment contract. So it's important to be sensitive to where your employees are actually based and which employment laws might actually apply. An employment contract not only covers the basic compensation items, and we'll come on to the benefit provisions later in this presentation, but also to cover other statutory elements such as post-termination restrictions. In Germany, by way of example, if you build into the employment contract a post-termination restriction, it is a requirement for that to be compensated. Typically it's 50% of the base salary for the period that the post-termination restriction applies. Now, in the US, I know it can be quite common to put in post-termination restrictions and then to waiver that obligation by mutual consent or subsequently down the line. If you do that in Germany and you put in a post-termination restriction, actually what happens is that the employee invariably will say, no, I'm not prepared to waiver that right. And because it's been written into the employment contract, there is then an expectation and now a legal obligation for the employer to actually pay out that post-termination restriction, even if the employer says, no problem, we're not going to enforce it. So the key point here that I'm trying to make is that there are local interpretations of and legal requirements relating to things which you would typically regard as variable terms in the US, but actually can have a legal ramification in the overseas territory if you're not careful about taking good advice up front. So in many countries, whilst there is no technical requirement to have a local employment contract, best practice would dictate that you do actually provide written contractual terms and conditions, and mainly so that everybody's actually on the same page and there's no ambiguity. It is key that the written contracts will cover the mandatory employment statements. For example, where does the employee work? What's the employee earning? As well as setting out any additional supplemental or private benefits that are awarded on top of the social security system. It's also important to understand that even if you have a employment contract or heads of terms that is written not in accordance with local legislation, that local legislation will always take precedence over a written contract where the provisions under the local legislation are more generous than the employment contract written terms. So even if you think you're getting away with, let's say, a US-style offer letter and that everything's signed up, don't be fooled, because actually in cases of employee contention or litigation, the local domestic employment laws will always apply. Therefore, it's key that you as employers understand what those, what your minimal obligations and quite frankly, best practice obligations are under local statute. The further thing to understand is that in many countries there are trade union or collective bargaining agreements which will affect the minimum or national laws that apply. So, for example, in France there is a senior category of employee called a cadre. This is a manager level or executive level employee, and they will be entitled to different mandatory benefits or mandatory provisions than, let's say, a blue-collar worker. The collective bargaining agreement will in turn influence things like minimum wages, mandatory overtime pays, and so not only do you have the different grade and seniority of employee affecting the terms and conditions of employment, you then have the influence of the different collective bargaining agreements affecting things like working time legislation. So it's really important to understand whether or not there is a trade union or a collective bargaining agreement applicable in country, whether it affects the grade and seniority of the employees within your organization, and how the different terms and conditions will be affected by each of those. What this boils down to is employment law is not a simple matter in many countries outside of the US, and particularly in countries like France, Brazil, Italy and Spain. The importance of language is obviously in the UK and places like the Netherlands and Sweden, for example, English is deemed to be the main language, and there's actually no requirement to have it translated into a local language. However, in many countries such as Belgium, France, and some of the Asian countries, there is actually an obligation to provide the written employment terms in the local language. The English translation is there purely for head office and for ease of using the contract, but when it comes down to relying on the enforceability of the clauses, it'll be the local language which becomes key. This also applies to other supplemental employment agreements such as confidentiality, proprietary agreements, and other items such as a bonus plan, commission plans and stock option plans. The point here is that it can be extremely expensive to obtain official translations of these documents, particularly if they're lengthy, for example the share plans, and that needs to be factored into the overall budget and cost when you're planning for your international expansion. And to try to shortcut that translation process can be dangerous because you get misinterpretation and then national law applying regardless of the actual terms of the contract that's the intent, because it hasn't been translated. So again, this is around both meeting the expectations of the employees and according to best practice in territory, as well as obviously meeting your legal obligations should there be a contentious argument with your employees. The other item to be careful of is ensuring that the terminology around employee benefits is clearly articulated. And let me give you an example of this. I see many contracts where companies provide for medical insurance or supplemental private medical cover. And depending on how that is worded in the contract, it could be the case that you are providing some sort of assurance or obligation to give that supplemental medical insurance to the employees regardless of the actual ability for the insurance company to be willing to offer the insurance. So for example, if you have an employee with a pre-existing medical condition which you don't know about and nor would you have any entitlement to know about, and you find that an insurance company is unwilling to provide insurance coverage, depending on how the wording around the benefit provision is actually construed, you could find yourself on the hook for having to provide the supplemental private, meet the private medical costs over and above any state-provided medical benefit. The important thing here is that you put in some proviso that it's you will provide the medical insurance, but providing the to the extent that an insurance company is willing to underwrite the employee or the life. So the other part here is ensuring that any benefit language that you put in the employment contract can be flexible. So when a company sets up overseas for the first time, the ability to provide supplemental or private benefits will change because the buying power or the credit history is going to be fairly reduced because it's only just set up. So the ability to provide group insurance terms is actually quite limited. However, over time, as your employee count increases, you have much more purchasing power with the insurance companies, and so therefore you may be able to change the benefit provision into a much more cost-effective plan. So it's important to retain as much flexibility within the terms and conditions of employment and not restrict yourselves to having to always go forward on the certain basis of what you put in on day one. Just want to run through some examples of how employment law impacts in reality. So for example, in Mexico, the federal law governs the termination benefits. So for example, the severance package is 3 months of final salary plus 20 days salary for each year of service, and then there is a seniority benefit, which means obviously you get more money if you've been in service for a longer period of time. That's important to understand if you're going to go through a mass redundancy program because it will affect your costings, for example. In Germany, the law requires you to supplement the state system if an employee elects to opt out. So it's discretionary at the employee's discretion whether they opt out of the state system, and if they do so, then the employer has an obligation to contribute to the private health insurance over and on top of the state system. So you need to have a system in place from an HR administration process to ask your employees whether they are or are not opting out of the system and maintain good records to track that. In the UK, we have recently introduced new pension legislation which requires an obligation for companies to provide a mandatory pension contribution which is contributory. But there is a whole heap of HR administration process that goes around servicing that pension requirement in terms of tracking which employees have opted in and opted out of the pension scheme. And even right now we're still in the process of learning what those administrative requirements are, and it's complicated. So even in a country where you might regard the UK as more employee friendly to the employees, there are still complications with respect to employee benefit provision. In the Netherlands, there is a nasty little provision which requires for the payment of sickness pay if an employee goes off sick for up to 2 years. It's calculated at a minimum of 70% of the daily wage, which as of the 1st of January 2012 was €191 per day. But as you can see, if somebody's off long-term sick, then that contribution can actually add up quite significantly. Now there are insurances out there to cover these liabilities, but you need to know about these rules in order to make sure that you put in place the insurances to protect yourselves down the line. And we often have companies, particularly in startup mode when they're trying to save money, who will say, well, let's save the cost of the insurance and not bother. And then what has happened is an employee can call in sick perhaps within 2 months, perhaps with stress or back problems. Maybe the employment relationship's not working out and they call in sick and they can see the writing on the wall, and the result is then the employer is on the hook for having to pay out salary in theory for up to 2 years at 70% of the daily minimum maximum wage. And it's incredibly difficult to fire somebody in Europe if they're off and they've been signed off work sick because of anti-discrimination laws. So it's important that you understand these requirements and then can provide for insurances to cover yourselves and protect yourselves as much as possible. And then in Australia there is a superannuation requirement which is equivalent to pension, which is a minimum employer contribution of 9% of salary. Again, it's important to understand these requirements because it will affect the overall cost and budget when doing business or hiring people in territory. So the key messages here are around planning ahead, understanding your minimum and statutory as well as best practice obligations so that you can get in front of this and manage the cost as you make decisions around international expansion and growth in a particular territory. Turning more specifically to employee benefits, the key message here is don't just be pressurized into providing the same level of benefits that you would in the US in the overseas territory. The reasons for this are numerous, mainly because each country will have different social security provision. So for example, in France the employer social security costs come in between 42 to 45% of salary, which are significant. In Belgium that number is around 33%. And for that contribution you would expect that the state level of benefits is significant, and indeed it is in those two countries. Contrast that to the US, where combined FICA and Medicare come in around about 8% of base salary, but in return the state benefits are pretty skinny or thin, and so therefore in the US it's very normal to supplement the salary with extra benefits such as life, medical, vision, dental, etc. Whereas in countries like France and Belgium, you wouldn't typically provide the supplemental benefits because it's already provided for under the state system. In other words, there's no one-size-fits-all, and each country's benefits, supplemental benefits requirements will have a close interplay with whatever the social security regime is in that particular country. In addition, the collective bargaining agreement may affect the supplemental benefits or mandatory benefits. So again, understanding that interplay between the national law and collective bargaining agreements is important. And then further, if you do decide to make a supplemental benefit provision, it's really important to understand what is market best practice, because again, if you're hiring, retaining staff, you're wanting to be benchmarked to your within the competitive market, competitive industries, for the size of company that you may be, and taking into account other elements of compensation such as stock option or equities. But understanding what is normal market practice is going to be key. So taking advice on that up front to come up with a compensation strategy which is appropriate to market is important. So just looking at some examples in terms of supplemental benefits. In the Netherlands and Germany, for example, it's very common for employees to be provided with a company car, rather than just by providing a car allowance or cash in hand. And the reason is that in those two countries it's actually tax efficient to provide the benefit of a company car physically through the provision of the asset versus a cash allowance. Now the problem for that is that for very many small companies, or particularly in startup mode, there is no trading history, there's no substance in territory, and they don't have a credit history. So the result of that is it's actually very difficult for these startup companies to obtain leasing credit or leasing finance and actually set up an arrangement. The result of which is that invariably we were just typically recommending giving a cash allowance. The other part of that is that you're not then left with an asset with a 3-year commitment, particularly if you're trying to be flexible and nimble in territory, noting the fact that you may or may not need to retract from a particular country. The upshot of that is that employees will typically complain because they are being taxed on a cash basis as opposed to a benefit in kind. And the answer can be as simple as, well, the company needs to gross up the cash allowance in order to make sure that net impact to the employee is as advantageous as if you had provided a company car. The point of going through that example is to say that even if you're not in a position to provide like-for-like benefits, there are creative ways of actually coming up with a competitive benefits package to meet a new or small population of staff. In Belgium, for example, and in other countries such as Scandinavia, Italy and Spain, it is a concept of holiday pay, which gets my American clients. There are additional payments on top of base salary called holiday bonuses or single or double holiday payments, which typically get paid out either in the December timeframe or over the summer period. And it harps back to fairly socialist employment legislation, which presumes that people need extra money to go on holiday. The result of this is that in countries like Belgium, the pay interval is odd. It's not 12 months. So for example, if you want to pay somebody $120,000 US, you don't just pay them $10,000 a month, because on top of that you would then have to pay an extra 1.92 months of salary to compensate them for the holiday payments. So you have to be careful about how you state the annual salary versus monthly. So in that example, you would take your $120,000 US, divide it by 13.92 to come up with your monthly installment. In Spain, it's typical to pay 14-month installments, whereas in other countries it may be 13 months. So again, understanding the whole interplay of holiday pay and impact on base salary is important. So to summarize that, it's key that you are sensitive to the market landscape, understanding the social security provision and the statutory provisions, to retain employees and mitigate employee discontentment. It's important not just to impose US market practices on the local territory, and to understand the balance, the relative importance of the balance between cash, benefits and equity. So for example, in many European countries, the concept of equity is a nice to have, but it's not nearly regarded as much as core compensation as it is in the US. And in countries like Belgium and Australia, for example, the equity is taxed upon grant as opposed to exercise or sale. And the result of that is that it can be a disincentive for employees taking equity-based compensation from the get-go, which is pretty key if you're a startup business or in an entrepreneurial world, trying to encourage and reduce your cash outlay at the start, where your employees actually reject a good portion of their salary package because they don't want to bear the taxes on it. So again, understanding the interplay of income taxes, social security on some of your compensation items is going to be key to setting a salary or a compensation package which is market norm. We would recommend undertaking of some sort of benchmarking analysis, both in terms of benefits but also other compensation items, as I have outlined. And this is important not just to kind of make sure that you can attract the right talent, retain the right talent, but also so that from a financial perspective you can undertake proper budgetary and costing analysis. So part of this is ensuring that there is good planning up front, which we've talked about repeatedly through this presentation, but also having in place good HR administrative infrastructure, which is key not only to actually setting up the program and selling the compensation, the employment contracts, the benefit programs to the employees from the get-go, i.e. attracting staff, but also then maintaining and managing that program internationally. So for example, if you have a number of countries where you have small populations, so for example 10 countries with 3 to 5 employees, it can very quickly become unmanageable in terms of the different benefit programs, the different administration requirements that are required. And it's important to have good systems behind you to understand what is required, but then to ongoing management. So for example, setting up a mandatory or a supplemental benefit program is relatively straightforward from the get-go once you know what you're doing. But then to maintain that program on a rolling basis as employees' wages change, therefore their pension contributions change, it can sometimes fall down between HR administration and payroll, and having that interplay between the relevant teams and understanding who's responsible for what, and being very clear from the outset about how you're mapping out the responsibility for managing your international employees is again key. So it may sound obvious that HR administration is important, but having those good systems to kind of regularly check in and make sure that nothing's getting missed between the HR team and the payroll team, particularly for some of these benefit items, is an area which I see companies falling down on, particularly when, as I said, static data, employee family sizes change or salaries change. The next section we're going to look at is the contractor and whether or not they're really regarded as employees. And these questions that I'm going to run through are the typical international tests, which I'm sure you'll recognize from the US perspective, of whether or not somebody is really deemed to be a contractor or whether they're really a de facto employee. The relevance of being a de facto employee, of course, is that you are then subject to employment law, payroll taxes, social security, and other obligations as an employer in territory. So if you end up hiring people as contractors who are then subsequently found to be employees, it can set in motion a chain of events, not only with the individual, but also with the relevant authorities. So some of the tests that we have to look at are whether or not the individual is free to work for other companies, or whether they're actually solely bound to one company. Are they able to influence the ability to do their day-to-day work, or do they take direct instructions from that company? Do they go around holding business cards in the name of the employer, in inverted commas, which would actually imply that the individual is really acting in the capacity of an agent of the business, i.e. an employee, versus having their own third-party business cards? Can the contractor have a right of substitution if they're off sick or go on holiday for 2 to 3 weeks? Could they, in theory, substitute their labour with somebody else? Are they free to use their own equipment, or does the company provide their own equipment? If they are using company equipment, it's again an indication that the person is really just acting as an employee of the company versus actually using their own equipment. And are they in receipt of employee-related benefits? What I mean by this is items such as stock options or bonus plans or commissions plans, which would typically be the compensation items that you would give to an employee of the company. So the point is, I think it's pretty obvious, if you answer those questions in a certain way, whether you will hand on heart be able to say whether or not the person is acting truly as a third party, or whether they're truly connected to the company more in the capacity of an employee. And the issue here, as I mentioned earlier, is not only are you potentially avoiding employment laws and obligations under that employment legislation, as well as paying payroll and social security taxes, if you then subsequently want to convert the contractor into an employee because you want to regularize the position, or maybe your plans have firmed up and you know what you're doing in territory, which often happens, it can actually be quite hard to convince the contractor to switch across to the employee without paying some sort of compensation for the loss of contractor status. And the reason I make that comment is oftentimes as a contractor, the contractor is able to offset certain expenses against their income such that their net income position is higher than that of an equivalent employee. So the point is, in order to buy out the contractor from being a contractor, typically you're going to have to throw money at that person. Further, they could in theory create problems for you if you try to get rid of them, because they will argue, or they could argue, that they effectively were an employee all along, and they could create waves with the authorities, both from an employment legislation as well as a tax perspective. Now, having said all that, we do see, particularly when companies are stepping foot or dipping their toe in a market, that the simplest route, just because it mitigates initial costs, setup costs, it means that you don't have to set up a payroll, and it means that you're very flexible in terms of being able to pull the trigger very quickly on having resource in country, is that the contractor route is often used. But it should be seen as a very short-term operating mode, because long-term, it's as you begin to build resources, it's going to be hard to hire other contractors on the same basis and to build a population. And further, you have no protections yourself that the contractors may not walk out the door and go to another contract. And I say it's short-term because really, in most cases when we look at it, the contractor is never really a true contractor. They're often deemed really an employee. So there are inherent risks, as we've just outlined. So there are some benefits with the contractor route. It is a quick, simple, relatively cheap way of hitting the ground in new markets, but it's generally not scalable, it's not long-term, and there are inherent risks, as well as the administration administration burden that you're putting onto the individual, because they're having to account for all their taxes and social security as a self-employed person as opposed to an employee. So we work with contractors in a very limited way, and it's not generally our recommended approach to actually setting up compliantly when you go into territory, but as I said, there is a place for them in the world. This really gives an example of where it can go wrong. So we had a US-based company had hired an independent contractor in Colombia, and that arrangement went on very nicely for about 5 years, when for economic reasons the company decided that they need to get rid of the contractor, which they thought they would just pull the trigger in accordance with the termination provisions of the contractor agreement. The result was that the contractor actually went to a labour court and claimed that she was a de facto employee because she'd been working for them for 5 years, and the evidence of the case, the actual substance of the matter, was that it was deemed to be an employment relationship. So not only did the company have to pay the professional fees and the legal fees for sorting this out, they were then hit for 5 years worth of failure to account for social security and employment taxes, failures to deduct payroll, penalties and interest on that, and of course they went back for 5 years, so it was a significant burden that was unexpected. And the issue here is that these things are uncontrollable, and you don't know whether or not a contractor is going to turn nasty down the line. So it's something just to bear in mind. So turning to the question of expatriates, which was our third category of personnel that international businesses look at. So why would you think about having an expatriate? Well, oftentimes an expatriate will have inherent knowledge. They'll have worked at head office. They have existing product knowledge and company knowledge, and they can hit the ground running in terms of launching a new marketplace because they just understand the business. Further, they can be an ambassador to in terms of market presence, but also in terms of recruitment, putting an energy force into an overseas territory. And helping transfer that culture and understanding from head office. The problem with expats, though, is that they are typically expensive. They're expensive not only in terms of the physical items that you need to pay for them to go overseas, things like relocation, housing, cost of living adjustments, etc., but also when you start thinking about the taxation and immigration requirements that go alongside having an expat program. So when you design an expatriate package, it's not just about giving them an airfare or a relocation payment to get them from A to B. It's much more around understanding what is the implication of the local taxation rules in that particular country, and are the tax rules actually going to impact the individual. So for example, if someone's typically going for more than 6 months to a territory, invariably they're going to establish domestic residence or tax residency in the overseas territory, which invariably means that their global income or their employment income is going to be liable to host country, that's the country to which they're going, taxation system. Now, in many countries, the effective tax rate is going to be higher than the tax that the individual was going to be paying at home, for the very simple reason of the fact that when you go overseas, you're going to have all these extra allowances paid to you, typically relocation, housing, cost of living, and unless something's put in place, you're going to end up paying tax on those items. And that's even before you start thinking about the difference in tax rates between, let's say, the US and the UK, or the US and China. So the point is, why should a company even bother about the tax position? Well, the answer is, if your expat is going to be made worse off by, let's say, 20% to their net salary, the answer is that that expat will likely not take the assignment, and if they took the assignment blind without understanding the tax impact, you're very soon going to have them knocking on your door complaining that their net income position has decreased significantly relative to their home country position. So it's important to have a good understanding of the tax position, the impact on compensation structure, the elements of compensation that you might be wanting to give to somebody, as well as fundamentally understanding the immigration requirements that have to be met before the expat sets foot and starts working in territory. And I reference that immigration piece again because it is the #1 thing that has to be thought about when you're beginning to think about sending foreign nationals into an overseas territory. So when you're structuring an assignment, these are some of the general considerations to think about. The duration, the relevant countries that are at play, which could be, let's say, the home country is the US, but maybe you're dealing with a Canadian national, and they're going to the UK, so you've now got 3 countries coming into play. The structure of the assignment, how long are you sending them for? Is it going to be regarded as a short-term assignment for, let's say, less than 6 months? Is it a secondment of 1 to 3 years? Or is it really a one-way ticket or a permanent transfer? And the potential liabilities that you need to be thinking about are exposure to a local employment law. So even if they remain a US employee, because they're working in the overseas country, they will have entitlements under local employment law, as well as the impact on the corporate tax position. We talked in the first slide, if you remember that far back, the exposure to the corporate tax nexus and the permanent establishment of activities being undertaken in the overseas territory. And if you've got an employee of the US company working overseas, that can be a direct link back from a corporate tax position to the head office. And then, as I mentioned, the tax residency position for income tax and social security of that individual and their own liabilities that they're triggering by spending time in the overseas territory, which has a knock-on effect for you for expatriate payroll requirements, both in the US, again I'm using the US as the home country, but also the host or the overseas territory. Rushing through because time is short, the 8 common mistakes that we see. Here's number 1, immigration. Let's get it right from day one. Have the right work permits in advance of sending your expat overseas. And it's important to understand the timing of this, because in some countries it can take 2 to 3 months to get the right work permits, which affects your commitments and your obligations to the market or your customer or to the individuals about when they're going to be going over. And in countries like the UK, it can take up to 6 months to get the relevant work permits, depending on the structure that you may have. The lack of appreciation and understanding of how complex expats can be, the impact that has on the cost, the complexity, the amount of internal time and administration that it takes to run an expat program. So actually really understanding what you're getting yourselves into before sending the expats across or even thinking about it. Payroll considerations, is it okay to keep them on the home country payroll, or do you need to be thinking about host country compliance and withholding taxes? And the simple belief that expat payrolls can be managed as simply as putting them on the local hire payroll, and invariably that's not the case. And split payrolls are generally illegal or not okay unless you undertake significant compliance obligations to make sure that the pay or the compensation that's been paid in one country is fully reportable and declared in the overseas territory. So again, we have to be careful about how we plan for and set up those expatriate payroll arrangements. It's important to have, again, good HR systems in place to track not just your full-blown expats, that's expats that are perhaps going for 1 to 2 to 3 years, but actually for commuters who might be whizzing backwards and forwards between 2 countries. I call this the 183-day drift. This is where you have people who are very mobile, whizzing around for business meetings, potentially going back and forth to the same country repeatedly, perhaps 2 weeks in, 3 weeks back, 4 weeks in, 2 weeks back, etc. And it's really important that those people are actually tracked, because they don't get classified necessarily as expatriates. They're effectively business commuters. But this can actually trigger local tax rules and social security implications if things aren't recognized and addressed up front. And the reason for that is because many double tax treaties talk about 183 days in a 12-month period being the relevant trigger point for triggering overseas taxation. So that's the 183-day drift rule. The next piece to think about is how do you account for intercompany treatments? So are the expatriates really working for the benefit of the overseas territory? Where should those costs be booked? Allowing an expat to actually make their own demands. The reason this is bad is because it will set a precedent. So if you have a population of 1, it's very simple to say, well, whatever he wants, we'll just pay him within reason a particular package. But of course, if you then have a second or a third expatriate, if there are no guidelines or policy being set, then it can set precedents around what the company actually does. So understanding that and being cognizant cognizant of it from the beginning is really important, and coming up with some sort of formula so that you have consistency and fairness across your expat program. And don't be fooled into thinking that things remain secret. Expats are the worst for sharing compensation details and for going down the pub and comparing their packages. So you will hear about it. And the last item is the personal element, actually, particularly if you're asking someone to relocate with their family, whether it's spouse and with children. There is personal upheaval in relocating from one country to another. And understanding and planning that well in advance, having transparency on the deal and the terms and their entitlements is really key to a successful expatriate assignment. And just one piece of advice is statistics say that the failure of expat assignments mainly comes down to the spouse being unhappy. And that's because the working spouse is at work, they're being challenged and stimulated in their new environment, whereas the stay-at-home spouse typically won't be working and will oftentimes get bored and is unfamiliar, is away from family and friends, and the main reason why assignments get cut short is mainly because the spouse is unhappy. So that's just a tidbit that I'm throwing out there, just to think about the personal elements of expatriate assignments. So we've kind of covered this already, but again, thinking about the classification of expatriates, whether they're short-term, whether they're commuters, whether it's a permanent transfer one-way ticket, and accompanying that is the length of assignment. The reason that the length of assignment is important is it will trigger the type of policy or the compensation items that you're going to be giving to somebody, and whether or not there is a tax implication in the overseas territory. So what we would typically recommend is mapping out what expatriates you have, what type of scenarios could play out, whether that's short-term, commuter, long-term, the length of time, and then coming up with a policy framework which actually gives you consistency across each of these areas, and you know exactly what you're going to be giving by way of compensation. By way of example of this, if you look at a long-term assignment, we would typically look at elements such as tax equalization, which is a way of addressing the inequity between the different tax rules. We would be thinking about payroll delivery, whether you're going to be splitting that between the home and the host, whether we keep them on a shadow payroll. The policy, what are we actually going to pay them in terms of housing, COLA, local benefits, etc. And understanding whether or not you're going to be, what support you're going to be giving to your employees by way of professional services, pre-assignment briefings, and cultural fit, making sure your employee is actually culturally aware and wanting to be able to fit into that overseas location. And one of the key elements to think about with expatriates is actually the repatriation element. How are you going to repatriate them and simulate them back into the home country work environment at the end of the assignment? So that's just an example of sort of the buckets of things that we would think about as we're planning a policy discussion around the expat assignments. The final few slides here is around the challenges of global payroll. And the key here is that payroll is often seen as what should be relatively straightforward. You just pay somebody gross to net, you run the taxes, done with it. The truth of the matter is that payroll is probably one of the unsung heroes of any corporate organization. It's actually incredibly hard to get it right in the international context. The reason for that is the rules around payroll reporting of what compensation items to report, how to tax the compensation items, when do we report items, is different in every single country. There may be standardized local systems that you have to use. Equity, for example, oftentimes causes a problem because what equity items do you need to be included in payroll? Is it a grant? Is it an exercise? How do you calculate the taxes? So if you get payroll wrong, as I'm sure you all know, you'll have employees crawling all over you. The expectation is you get it 100% right every single month and no one thanks you for it. But actually doing that in the international context is incredibly hard. So the item here is to really take a studied approach around understanding the payroll rules, the tax rules, and the interaction between the payroll systems. Key message here is the tax rules. The rules are not the same in outside of the US as they are in the US. Items such as paydays change. In the US it's common to pay twice a month. In most other countries it's once a month. There are, as I said, different rules and reporting obligations and even tax rates that apply to different elements of compensation. So, for example, bonuses in China, you can have a preferential tax rate if you structure your employment package in a certain way. And obviously, getting it wrong in terms of non-compliance with the local payroll obligations can result in significant interest and penalties, as well as reputational risk and damage with both the governments and the tax authorities, as well as your employees. And increasingly, given the economic climate that we've been through for the last 3 to 5 years, we're seeing a big push by the tax authorities to actually audit the payroll systems in terms of compliance with tax reporting. So in the UK we have real-time information, which means that you have to get it right each pay period. It's no longer acceptable just to true up things at the end of the year. In China there are individual income tax reportings each month that have to be filed. And there are different cantonal, provincial, city, state, as well as federal taxes that come into play. So it's important to kind of address and understand each of those different elements, as well as the social security elements that go along with that, because it's not just income taxes we're talking about, but actually withholding and calculation of social security. So I think the key message here is payroll, the unsung hero. It's difficult. Take the time to get to understand what the obligations are and understand the tax impact reporting obligations of each compensation item that you may be thinking about giving. And with that, I'd like to thank you all for your time and attention, and I hope it's been helpful.
Okay, thank you very much. With that, being mindful of our time, we're going to close the Q&A session, and we will coordinate with our speaker getting answers to your questions that were unanswered. And that first, I'd like to thank Katie for her time and insight. She's her interest in being connected with Katie with just a few mouse clicks. Thanks again to our sponsor, High Street Partners. And finally, a big thank you to the audience for your valuable time. Make the rest of your day great, everyone. Thank you very much.